Alastair, welcome to Trade Finance Talks TV.
Great, it's great to be here.
Thank you. So, thank you for joining us. What's your elevator pitch? Who are you? Where are you from? And what do you do?
So my name's Alastair Hughes. I work at the Bank of England. I work in the markets area of the bank, and one of the things we look at is market structure and making sure that there are fair and efficient markets for everyone in the UK. One aspect of that is financial benchmarks, and particularly the LIBOR benchmark. It's a name that often kind of resonates with people, but LIBOR is coming to an end, necessarily coming to an end, and we work to try and help businesses and end users move away from the LIBOR rate as swiftly and safely as possible.
Yeah, and some people call it the world's most important number, some $300 trillion of contracts involved in LIBOR. Can you give us a bit of a history of LIBOR and why it exists, and also why its demise has been recommended?
Sure. So LIBOR is a financial benchmark. Benchmarks are really important. They provide transparency, they provide consistency, and they provide somewhere where we can coalesce and manage risk. And ultimately that reduces costs for people, which is a good thing in markets. LIBOR has been around for 30, 40 years, different stories of its origins, but sort of the late 60s it emerged in the syndicated lending market. And the idea being to have a benchmark or a reference rate that reflected banks' cost of funding. At that time, it reflected the interbank funding market. Now, what has happened in those 40 years, LIBOR has become very embedded in the financial system. We've seen it used across a whole range of products, much wider than it was intended, from mortgages to derivatives to lending products. But the markets on which it's based, and these benchmarks do need to be representative of those markets, is just not active anymore. Certainly since the global financial crisis, banks have moved away from funding in those interbank markets, and there's no longer sufficient transactions underpinning the market to support it. So the banks that provide the data aren't going to do that. LIBOR rates are going to cease for new use at the end of this year, so people need to make sure they're ready to move to alternatives, and they have plans in place for their legacy LIBOR exposure, and we're here to help with that.
Thanks, Alastair. So what are the key changes in terms of LIBOR's replacement?
So there are different recommended rates in each of the currency jurisdictions. In sterling markets, an industry group back in 2017 recommended SoNIA. SoNIA is a rate produced by the Bank of England. It's underpinned by a strong underlying set of real transactions. It's data that's collected by the Bank of England, and it's built to be robust and to reflect, as I say, those real underlying transactions. Now, SoNIA is an overnight rate. That makes it very robust. But it also means that while overnight rates are very familiar in derivatives markets, some changes and adaptations need to be made to it for it to be used in lending markets to be closer to the 3-month tenors that we're used to. One of the other differences is, as an overnight rate, SoNIA has to be either compounded in arrears or turned into a forward term rate, whereas LIBOR is a forward term rate. At the start of the interest period, you will know what your LIBOR payment is. It's one of the things people like. It's also one of the aspects that makes it weaker than some of these robust overnight rates. And lastly, LIBOR includes risk premia that is not in SoNIA. SoNIA is what is called a risk-free rate. LIBOR has some quite opaque credit and liquidity risk in there. So there's a small difference between them. Often people talk about something called the credit adjustment spread, which is the difference between the two.
Thanks, Alastair. So what are the next steps in terms of the roadmap as we kind of transition from LIBOR to SOFR?
So yeah, I mean, that deadline is coming up on us pretty quickly. Sterling LIBOR will cease at the end of this year. New use of all the LIBOR currencies will come at the end of the year. But the important thing is there is time and there is help available. So as I say, new use of LIBOR will cease from the end of this year. In sterling markets, the SoNIA alternative we've talked about is now well embedded. The SoNIA product set is very liquid, it's available. It accounts for 80% of new linear derivatives trading. The whole range of risk management products people will be familiar with, caps and floors and swaptions are available in SoNIA. And since April this year, SoNIA-linked lending has been one of the main products put forward, and there's well over 50 billion of SoNIA-linked lending being used by all types of sectors and all types of facilities now. So the new products are in place. So what I say to you is, if you're being offered LIBOR products today, stop, think about it, ask your provider. Certainly in sterling, that product set is there. Then I'd say check your other LIBOR exposures. So if you've got historic LIBOR exposure that runs beyond 2021 in sterling, you're going to need to think about what reference rate you would use going forward. We've been encouraging people to look at those contracts and amend those rates if they can with their customers. There's huge amounts of help and advice out there. on the Bank of England website. Indeed, you've got your own resource. So I'd look at that. That can tell you about this credit adjustment spread and how to move fairly from one rate to the other. And lastly, if you're dealing with contracts which are what people tend to refer as tough legacy or stuck contracts, there's help in place there. Now, this is a safety net. It should be looked upon as a safety net. But my colleagues at the Financial Conduct Authority will produce something called synthetic LIBOR as a temporary bridging measure. It won't be in place forever, but what it will do is make sure there's no break in the availability of rates for those contracts. So understand your exposure to LIBOR, plan, and look to move across as soon as possible.
Thanks, Alastair. And of course, in respect to trade finance, what are you seeing in the market in terms of perhaps term rates versus compounded overnight and arrears rate?
So certainly we expect compounded and arrears SoNIA to be the most widely used rate in sterling markets. It's where the most liquidity will be. But we have always recognised that a term product will be necessary for certain parts of the market. And so we've been working with the industry for well over sort of 3 or 4 years now to make sure those rates are available. In sterling markets, there are 2 term SoNIA reference rates available from 2 well-known benchmark providers. Those rates have been live for use in contracts since January this year. And there's very clear guidance on who should use those rates. There's guidance put out by the Risk-Free Rate Working Group, which is an industry group set up by the Bank of England. There's also further guidance from the Financial Industry Market Standard Board, the FIC Market Standard Board. Now, elements of trade finance and discounting do require that forward term rate. We recognise that, and that rate is live and active and there for people to use today. We also recognise in other currencies that's important. Dollar finance, particularly important. And again, in the US, SOFR, which is the recommended alternative to dollar LIBOR, has a term rate available provided by CME in the US, and that's available to use as well.
Thank you very much. So for those trade finance participants who are still, I guess, finding their way through the transition, what advice would you give?
So first I'd say, if you're burying your head in the sand because someone's told you LIBOR is going to continue or you don't have to do anything, that's definitely not the case. LIBOR will cease. The journeys look slightly different in different currencies, but the destination is the same. So you do need to engage. You need to understand what your exposure to the LIBOR rate is, both in terms of future use of products and indeed those legacy products, and indeed if you use LIBOR in pricing or valuation models. You then need to work to have a plan to transition across. As I say, your financial service provider will normally be able to help you with that. There's huge amounts of guidance from trade associations, from the bank itself. I'd kind of look at these safety nets, as I say, these kind of synthetic LIBOR in the UK or other areas in the US as kind of safety nets. I'd engage, look at these recommended adjustment spreads and look at moving across to either SoNIA plus the adjustment spread or SOFR plus the adjustment spread, or what works in those specific situations. So where possible on those legacy contracts, renegotiate them. If they're contracts that are going to be difficult to renegotiate, look what legal basis that contract is on, whether it's on UK law, US law, and make sure you have either robust fallbacks in place or you understand the mechanism that's going to transition those contracts. And make sure you're speaking to your clients and your financial service providers about that. But the most important thing is to engage, and if you do engage, there is help and support out there for you.
Thank you very much, Alastair. Engage, absolute key there. And I must plug the for TFG LIBOR for Trade Finance Hub on tradefinanceglobe.com/LIBOR. Thank you.